Following the reeling effects of the 2007-2008 financial crisis caused by banks offering subprime mortgages and thereafter selling the mortgages to hedge funds that bundled the mortgages into collateralized debt obligations and sold them to investors who insured them through credit default swaps, the bank's business model seemed like a well-oiled machine until the Feds raised interest rates. This led to mortgage defaults that catapulted the country into a financial and housing crisis. The aftermath of the crisis led to the Obama administration signing into law the Dodd-Frank Act, which was dubbed the Wall Street Reform Act, which was touted as the most comprehensive financial regulation since the 1940s Great Depression. The Act increased accountability and transparency requirements for financial institutions, regulatory adjustments, and increased bank preparedness for bank runs. The Act had two main themes: one, to end bank bailouts by the government, and two, that the taxpayer will no longer bear the cost of Wall Street greed. The Act also imposed a strict regulation known as the Volcker Rule that limited banks from investing or owning hedge funds or equity funds or proprietary trading operations for their own profit. The Obama administration also signed into act the Consumer Protection Act that protected customers from unconscionable financial practices that spread due to lack of regulation and also protected consumers from predatory mortgage lenders. However, the Trump administration signed a bill into law loosening the grip on the regulations on banks. Trump stated that the Dodd-Frank Act was merely a bureaucracy. These words would come to bite him, as in 2023, banks faced the mother of all leviathans, and sadly, most of it succumbed to it. It all started with a simple concept. The fractional reserve system was created after the Great Depression, where the stock market crashed. The fractional reserve banking is a system where commercial banks are required to maintain only a fraction of the total deposits while the bank lends out the rest. So what happens when people clamor to withdraw the deposits at the same time?
Of a collapse of a big bank and the anatomy of a rescue from the federal government. Let's look at how we got here.
Silicon Valley Bank was the 16th largest U.S. bank that gained its stripes by financing and offering banking services to venture capital-backed startup companies. As other banks were risk-averse, the pandemic saw a tech boom. This is where tech companies saw a surge in consumer habits, such as streaming services, i.e. Netflix, e-commerce with Amazon. It also saw the launch of cloud-based services and also video sharing software such as Zoom. Moreover, venture capital-backed companies in the U.S. raised approximately $130 billion in spite of the pandemic. Startups also benefited from stimulus packages. Tech companies thereafter had a large influx of cash and deposited in Silicon Valley Bank. The Silicon Valley Bank thereafter made a shrewd decision, or so it seemed, by investing the colossal deposits into long-term treasury bonds and mortgage-backed securities. However, in an unprecedented event, or so it seemed to the untrained eye, to curb the rising inflation, the Federal Reserve hiked interest rates in 2022, which prompted the inverse relationship with bonds. As interest rates rose, the bond prices fell. While it was prudent for SVB to invest in long-term securities such as treasuries for more yield, they, however, did not protect their liabilities with short-term investments for quick liquidation. The rise in inflation led to huge tech mass layoffs, which saw bank customers withdrawing deposits as venture capital dried up. On March 8, 2023, SVB announced it sought to raise $2.5 billion in capital. This caused panic and caused a bank run, and since SVB deposits were tied in long-term investments, they didn't have cash on hand to liquidate. They were thereafter left with one choice: to sell their bonds before the maturity date, leading to significant losses. It's alleged that SVB took a $1.8 billion hit, following a $21 billion fire sale of its invested bond portfolio. The bank was now on a slow descent, and it only got worse. Within 48 hours, the bank showed signs it was on the brink of collapse. On 9 March 2023, as customers in droves sought to withdraw their money from SVB, the SVB stock plummeted by 60%. Ultimately, on March 10th, California regulators wound up the bank and placed SVB under the Federal Depositors Insurance Corporation. On March 12th, President Biden assured bank customers that all deposits would be covered despite the FDIC $250,000 limit. On March 26, 2023, FDIC announced that First Citizens Bank will acquire Silicon Valley Bank and assume the majority of its deposits and loans. The FDIC estimated the SVB collapse would cost it approximately $20 billion. The question therefore lingers, would all of this been averted? According to SEC filings, around February, just days short of the bank's collapse, the CEO of Silicon Valley Bank, Greg Becker, sold $3.5 million worth of stock. Just as SVB was on a slow descent to collapse, a further bank that was touted as a crypto-friendly also bottomed out. However, this was a bit different. On 8th March 2023, Silvergate Bank's holding company, that is the Silvergate Capital Corporation, announced that Silvergate Bank would begin the process of voluntarily liquidating the company. Silvergate, which was one of the first in the banking industry to offer financial services in the crypto sector, was winding down its operations. Silvergate Bank had notable clients which included the ill-fated FTX, which not only caused a domino effect in the volatile crypto sector but also with Silvergate Bank. Following FTX's collapse, the bank faced a putative class action suit in which Silvergate was accused of aiding and abetting a multi-billion-dollar fraudulent scheme which was orchestrated by Sam Bankman-Fried, the CEO of FTX, and Alameda Research. However, the winding up of Silvergate Bank cannot be attributed only to the collapse of FTX, as sources within the crypto sector alluded that Silvergate's liquidation was due to a lack of risk management, as it faced exposure on volatile short-term deposits while lending or investing at longer durations. In January, the bank saw customers withdraw $8.1 billion. On March 1st, it filed its annual report with SEC, which proved the bank had liquidity issues. It also got a downgrade rating from Moody's credit rating. With Silvergate announcing its voluntary liquidation, it also shut down Silvergate Exchange Network that acted as a real-time payment platform, which facilitated crypto transactions with its notable clients such as Gemini and Kraken. On March 12, 2023, just 2 days short of the Silicon Valley Bank collapse, federal regulators shut down Signature Bank following a $1 billion bank run. This has been regarded as the third largest bank collapse in financial history. This prompted the DOJ and SEC to investigate the collapse of the bank, specifically with its ties to cryptocurrency, potential money laundering, and violation of the federal securities law. Signature Bank had notable clients, including Trump, with whom it severed ties in 2021, and also the ill-fated cryptocurrency exchange FTX. Signature Bank is also embroiled in an FTX class action suit in which it is alleged that Signature Bank had knowledge and facilitated the commingling of FTX customers' funds with Alameda Research and with its blockchain-based network, Signet. In the class action suit, the fall of Signature Bank was attributed to mismanagement and overexposure to crypto, which later on mandated regulators to shut down the bank to protect depositors and also put a stop to potential risk to the financial system. Later on, FDIC assured depositors that their money was covered and announced that New York Community Bank Corp subsidiary, the Flagstar Bank, would be acquiring Signature's bank assets. Following the collapse of Signature Bank on March 14, 2023, shareholders sued the bank for declaring itself financially solvent just days before regulators seized the bank. On March 19, 2023, news outlets broke the news that a too-big-to-fail bank, Credit Suisse Bank, was on the brink of collapse. The bank had over the years gained a dark reputational cloud. Credit Suisse has faced backlash over aiding politically exposed persons, more specifically dictators. It's believed that Credit Suisse employees opened a bank account in the name of William Sonder and James Ryan. These accounts were primarily used to launder an estimated $5 to $10 billion. Upon investigations into the laundering activities, this led to a rabbit hole which exposed that the account names William Sonder and James Ryan were actually fictitious names which were used by Philippine dictator Ferdinand Marcos and his wife. Credit Suisse was again the center of attention, where it was revealed that an African country, Nigeria to be specific, military dictator, had laundered allegedly $214 million proceeds of corruption at the bank. Credit Suisse was also allegedly involved in the laundering of money for Japan's most violent criminal gang, the Yakuza gang. The Swiss bank was also embroiled in one of the biggest criminal trials in Swiss country's history, when a Bulgarian drug ring was laundering money, specifically $146 million, through the bank. In 2019, Jean Thiam, the CEO of Credit Suisse, was entangled in a corporate espionage scandal. All this unraveled following Credit Suisse wealth manager Iqbal Khan terminating his contract with Credit Suisse and joining its biggest rival bank, UBS. Following his departure, it's alleged that Jean Thiam had a private detective who spied on Iqbal Khan. It's believed that Iqbal Khan was with his wife in Zurich when he picked up on the surveillance and confronted the private investigator. As news from Credit Suisse Spygate made headlines, Credit Suisse swiftly fired top officials and entered into an out-of-court settlement agreement with Iqbal Khan. In 2013, Credit Suisse became implicated in plunging an African country's economy into turmoil. It's alleged that Credit Suisse and Russian VTB Bank financed allegedly more than $2 billion to three Mozambican state-owned entities, that is Pro-Indicus, Emerton, and Mozambican asset managers. The loan being disbursed was a $1 billion state investment into a maritime fishing project in Mozambique. The loan was disbursed to the alleged three state entities without Mozambique's parliament approving the loan, as was required due to the fact that Mozambique's government was a guarantor. While the sole purpose of the loan was well-intentioned, the people behind it saw things differently. It's alleged that Credit Suisse Group AG, its UK subsidiary, Privinvest, a UAE company, and the three alleged Mozambique state entities conspired to defraud investors through a series of kickbacks from contractors, bribery of government officials, diversion of the use of the loans, and materially misrepresenting Mozambique's ability to pay the loans, and most importantly, materially misrepresenting the maturity dates on those debts owed. It came as no surprise that the maritime tuna fish project in Mozambique didn't really materialize. It would soon be revealed that Emerton, the state-backed entity, was unable to service back its loans. In 2016, Credit Suisse agreed to restructure the loans and convert Emerton securities into a bond with a longer maturity date. It wasn't long before the material misrepresentations made headlines. This caused Emerton securities to drop, causing losses not only to the investors but also the country, which lost a third of its GDP and got blackballed by other foreign donors, including the IMF. Credit Suisse was eventually found culpable in the Mozambique maritime scandal and agreed to pay up $475 million and write off allegedly $200 million of the country's debt. Credit Suisse collapse was catapulted by the fall of Archegos Capital Management, an investment firm that offered prime brokerage services. Archegos Capital Management used total return swaps. However, all this unraveled in March as Viacom CBS share price dropped following a stock sale. Archegos was put on the spot when its prime brokers, which included investment banks such as Credit Suisse, demanded Archegos to put up their money upfront to cover the fund's exposure following Viacom's share price drop. Unfortunately, Archegos failed to meet the margin call, which resulted in Credit Suisse counting losses of an alleged $5.5 billion. It's also alleged that it had to raise capital, an alleged $1.9 billion, to show up its balance sheet. The Greensill Company scandal. A SoftBank-backed fund that secured a $1.45 billion funding that equally enjoyed the support of British Prime Minister David Cameron. Greensill Capital business model was novel in the industry. It included supply chain financing, which is whereby Greensill Capital took on the role of a financial intermediary, providing necessary financing for a buyer to pay their supplier. Thus, Greensill Capital generally purchased invoices of their clients and paid their suppliers. Greensill would thereafter bundle the invoices as securitized loans in which it would sell off to financial institutions such as Credit Suisse, which in 2017 launched first of 4 funds in the Greensill supply chain financing. So what could go wrong? Greensill filed for administration in March 2021. Greensill's fall was occasioned when its clients began defaulting on its payments, leaving Greensill overexposed. One of its biggest clients, a metal conglomerate, GFG Alliance, defaulted on a $5 billion loan, and this impacted Greensill's financial liquidity, making it impossible for them to service their loans to Credit Suisse. With the collapse of the Greensill Capital Company, Credit Suisse lost $10 billion worth of funds. Following Credit Suisse scandals, rumors swirled that the bank was on the brink of collapse. On March 14, 2023, Credit Suisse announced that it had found material weaknesses in its financial reporting for 2021 and 2022. The bank sought its largest shareholder, which owns 9.9%, the Saudi National Bank, to inject more money into the bank. However, much to their dismay, the head of the Saudi National Bank announced that they would not be making any investment into the bank. Following the comments, Credit Suisse stocks plunged plunged less than 24 hours later, Credit Suisse borrowed $54 billion from Switzerland's central bank. However, once this was made public, this caused a bank run. Following this downward spiral, UBS, a rival bank and the leading Swiss-based global wealth manager, acquired Credit Suisse in a hostile takeover in a government broker deal for approximately $3.4 billion. The deal was brokered despite Parliament's disapproval. However, trouble was still brewing in the acquisition, as it was revealed that shareholders would receive one UBS share for every 22 Credit Suisse shares, while subsequently the deal wiped out $17.5 billion in 81 bonds. One would be forgiven to think that after the Leviathan devoured SVB, Signature Bank, and a too-big-to-fail bank, Credit Suisse, that we would all heave a sigh of relief. Unfortunately, news outlets broke the news on another bank failure, which was considered the second largest bank failure since Washington Mutual in 2008. First Republic Bank had long gained notoriety of offering long-term mortgage loans to affluent clients in exchange for huge deposits of cash. However, with the rise in interest rates, this negatively affected the value of mortgage loans. On March 11, 2023, JP Morgan injected $30 billion into First Republic Bank to boost investor confidence after its shares had plummeted to a record 62%. On April 24, 2023, the bank reported a 41% outflow in deposits, which approximated $100 billion in the first quarter. On May 1, 2023, it was announced that JP Morgan Chase Bank had acquired First Republic Bank. Assets and liabilities, which include $173 billion in loans, $30 billion in securities, and $42 billion in deposits. It's still too soon to say whether banks are in the clear or whether the Leviathan is still out there.